Hello fellow investors and traders. Today I will talk about my crypto hedge fund. I will go through some performance and give a quick summary. Then I will delve into scarcity, why stocks only goes up, say something about the strategy of the fund, the algorithms for crypto trading, gold, equities, and maybe reveal what I expect from the future. So eToro is a trading platform. It's a social trading platform where you actually can copy other people's trades. This is the performance. You can see the graph below here, the performance, and it's been great. You see the percentage here. Last year was 189% and 32% for the first quarter this year. And the risk is it's a risky fund. So the style is the reason why this is a very risky fund is the offense part of it. You see, this is a barbell. This guy is lifting the portfolio and he wanted to be equal weighted offense and defense. And you have the cash in the middle. So the idea is that the offense part you earn, I expect to earn on the offense part. And what I earn, I harvest some of it and rebalance it into defense. So I try to keep this balance most of the time. The strategy is basically I hold a lot of gold, precious metal, and some stocks. And I have the flow traders, which I consider a long volatility play, and then the cash, of course. So this is a chart of the S&P 500. As you can see, it seems like it's just going up. It goes back to, well, this is almost Napoleonic Wars, and all the way till now. You can see that it seems like something happened around here somewhere. Exactly where, I don't know, but seems maybe I suggest that it's here because the slope of the curve increases a lot faster now compared to previous years. And why is that? Well, from this point of history, from this point of history, we have seen an increase of 2,812%. That's a lot, by the way. And during the same time, the money printer have been going brrr. After the war, it was not much happening, and then maybe the slope started to change around here, and then even more and even more, and now it's going completely crazy. And what do this mean? Well, I I thought that it meant that this curve isn't real because you are nominating the stock market in dollars, and there's more dollars all the time. So I think that's why stocks only goes up, because if they go down, they just make more dollars. It's a nice way to screw everyone, isn't it? Except the guys who hold a lot of stocks. So what we are doing in the next chart is we are taking this from this point here till here, and we are dividing it by this chart here to get a representation for the same dollar all the time. Right? You see here that the dollar you had here, it's cut in half by this point, and then it's cut in half again and again and again and again. So this is how it looks if you divide the S&P 500 by the money supply. Stocks is really not just going up. And the 2,812% is just 139. It's still not like nothing, but what do this mean? There's another story, and it's a gold story, because prior to the depression in the 30s, you had dollar fixed to the price of gold at a rate of 20.67. And then Roosevelt, he made it illegal for Americans to hold gold. It was an executive order. So all the Americans, they had to hand in their gold, and they got the value of gold. This is the first devaluation in modern times, in America at least. But then you had the Bretton Woods, and time goes. And what's going on here is that Americans can't hold gold, but foreigners, they could. And the Europeans, they wanted to change their dollars into gold. So a lot of gold went from America to Europe. And that was a problem for the Americans, of course. So Nixon, he shocked the world by just delinking the dollar and gold. And then what happened? Well, gold went ballistic. In about 10 years, it made 25x. It peaked, of course. This was probably a euphoric upward move, but still, it's 25x. It's quite crazy. And then you had a bear market for a long time, and then it's been going up again since. So if we, instead of dividing the S&P 500 by the money supply, divide it by the gold, you see something special again. At least here, remember that in 71, the delinkage happened. So from here and to the left, what you're seeing is the S&P 500 nominated in gold or dollar, but then the link is broken here. And when the link is broken, eventually inflation starts to pick up, and it picked up quite fast. And you had at the max, I think it was about 13% inflation. And that lasted till around 1980s. And Paul Walker, he managed to stop the inflation by increasing rates a lot. You can see that here. This is where the dollar and gold link is broken, and you have inflation picking up. And at that time, rates was not high enough for inflation. What I'm saying is inflation rate was above the interest rate. So the real yields was negative. When the real yield are negative, that is very positive for gold. You see here, this is the S&P 500 to gold ratio, and this is the gold. You see gold is going up a lot because real yields are negative. But then Paul Walker, this guy here, he was the Fed chairman at the time, and he increased rates a lot. So he made the interest rate go above the inflation rate. Real yields were again positive. That created a recession, a deep recession. You can see that here, that the stock market was going down very fast, and a volatile gold market. But eventually, then real yields was positive again. And when real yields are positive, it's a good idea to invest in bonds. So that means people sold their gold position and put it into interest-bearing instruments. So from that point on, real yields was positive and gold was not really a favorable investment. From that point on, every recession have been fought by reducing the interest rate. On the chart here, you can see how the federal debt level increased from the point where interest rates went from going up till going down. Of course, the public have borrowed a lot of money since then. And one may argue that, well, this is nominal values, but well, I said that they print a lot of money, so what do this mean really? Well, you need a denominator. So if you consider public debt per GDP, you see how much debt is it compared to what you produce. You see, still the debt level is increasing a lot from the 1980s, from this point here, where you have maybe 30%. Now it's more like 130%, so it's really not good. This is a long-term chart. This shows how what usually happens when the debt to GDP ratio goes ballistic. Well, normally we need to deleverage the system, and that deleverage that happens here and here and here. And what's going to happen now? I don't know, of course, but I suspect we will deleverage from this point as well, because the debt level we have now is not sustainable. So The way to do that is probably to run inflation higher than the interest rate. Because if you do, you will inflate away part of the debt. That is what have happened historically. And if that were to happen, that will be very, very bullish for gold, because then again we will have negative real yield. So money isn't scarce. We need to invest our money in something scarce to protect our purchasing power. And that is what we are trying to do, to hold various scarce assets. And it helps if it's not correlated. So the offence part, I haven't talked much about that at all. Let's delve into that. So this is the Bitcoin algorithm. You can see the yellow one is the Bitcoin at itself. The pink one is the algorithm. The white area is where I am long, and the gray is where I'm short. So you can see how it goes separate ways when it's gray background. Most of this, what you're seeing here, is a backtest. The algorithm is written in a way that I can test how it would have done in previous times. But I have been using this algorithm since around here, since the beginning of 2020. And I was short Bitcoin at the COVID outbreak. That was, of course, very profitable. And I was not short here. Why didn't I listen to my own algorithm? And there's a reason for it. As you can see here, there's a mining cycle. The thing is, the miners, they get rewarded Bitcoin for securing the blockchain. The miner who get to add the next block, he get rewarded. At this time in history, they got 50 Bitcoins. And here it was 25. And here's 12 and a half. And look, every time after the halving, the price goes up. That have happened every time. And I expected it to happen here as well. That's why I didn't short at this point. I was long. The Ethereum algorithm is far more reluctant to short. And you can also see that Ethereum is much more volatile. And when the underlying asset is more volatile and it trends nicely, like Ethereum have actually done, it's easier to capture some alpha. So I do not expect this to happen in the future, but the backtest actually showed 27x the Ethereum algorithm itself. So this is not 27 time in dollar value, it's 27 time in Ethereum value. That is insane. And of course, I don't expect that to happen in the future. And it's also very important to say that most of this alpha was created during the bear market, because Ethereum fell a lot, and the algorithm suggested short most of the time. After that, well, it's done quite okay. Like here, it created a little bit alpha, maybe a little bit here. But the last few times, not so much. I shorted here. This is in the first quarter of this year, and we lost some money due to this. And that is a part of that is how this thing work. There is no 100%. Litecoin is the same. We tried to short here, didn't work out so well, but the backtest still gives very great alpha, 17x the Litecoin algorithm itself. So this chart I picked up from Tavi Costa in Crescott Capital. He tweets a lot of great stuff, and yeah, I picked this up from him. This is the commodities to equities ratio, and commodities, that is like oil and copper, corn, all this stuff, and it goes from one extreme to another, and I believe we are now at one extreme. And the interesting thing is that I believe in inflation, and that actually fits very fine with where we are in the commodities cycle. Because during the tech bubble, of course, commodities were dead cheap, and same during the Nifty 50 bubble. And Now, since we are printing a lot of money and planning to spend more on infrastructure, stuff like that, of course, commodities will go up. Well, I think they will anyway. And since a lot of these companies make money today with today's depressed commodity prices, what are they going to do when commodities eventually start picking up? We don't only have commodities, we also have emerging markets. And this chart here we see this is the S&P 500 and this is the emerging market. And you see here, the emerging market was really strong prior to the great financial crisis. But after that, they really never recaptured the old high. You see here, we are still below. If you compare that to the S&P 500, it's a very different story. The S&P 500 gone very high. And of course, the valuation have been stretched as well. Emerging markets are, it's not dead cheap, but it's okay. While the S&P is of course not cheap at all. Price earnings, but it doesn't really matter what kind of valuation metric you are using because they all tell the same story. You can use price sales or you can have different metrics divided on GDP. I've seen them all, and again, Crescent Capital have a lot of really nice tweets about it, so it's worth looking into. I also think this chart is important because this shows the emerging market now. This is the emerging market fund that we are invested in, and this is the dollar index. And you see here that when dollar is going down, emerging market is going up. And that is logical because a lot of emerging markets, they borrow money in dollars. So if the value of dollar is going down, that is great for them because then their debt level is actually being reduced. So when the dollar is going down, that is normally very good for frontier and emerging markets, maybe especially frontier markets. And you see the same all over the place here. I think the correlation is not perfect, but it's clearly there. You see, it's inverse correlation. And now you see, since the COVID outbreak, the dollar has been going down and emerging market have been going up. But you see but you see now we've been struggling a bit. I think I haven't gained anything on the emerging market yet, but I expect to do so in the future. I think this is the last chart. It's about flow traders. I reckon flow traders, it's a value play as well, but most importantly, it's a long volatility play. That is because flow traders, they are a market maker. That means they provide liquidity into the market. Like in the order book, you have a buy side and you have a sell side, and they tend to play both sides of this. So when the market is volatile, that means like here you have the prices going down. The spreads, that means the difference between the buy price and the sell price in the order book, start to increase. And when the spreads are increasing, they are earning more money. So that's why I call it a long volatility play. And you can actually see that, for example, here, S&P dropped a lot during the COVID outbreak, while flow traders went up. That concludes the presentation. As I said, this is the first time I ever done this, so if you like it, I would really appreciate it if you press like. And if you want to invest in this fund, or if you want to start investing in eToro, please consider using the link below. I would be very grateful for that. And take care and good luck with your investments.